So how much life insurance do I really need? So hey everybody, welcome back to the channel. If I haven't met you yet, my name is Bill Drexler. I'm a certified financial planner with Financial Cornerstone Group. And one thing, perhaps infuriatingly, about financial planning is a lot of the questions that we get are prefaced with the same answer, and that's it depends. So when we're talking about how much life insurance someone really needs, it really depends. And it's not a cop-out, it's just that everyone's situation is different. And in today's video, I'm going to talk about four methods to determine how much life insurance is appropriate for someone in their family. Three are actual methods, and one is more of like a general guideline that you just can't really go wrong with. But before we start, some key questions to ask yourself when we're talking about how much life insurance we may need. How much is left on your mortgage? How many dependents do we have? And when I talk about dependents, not just young children, but aging parents, any special need family members that depend on your income. What is your household income? How much debt do you have? Any current assets? Any liquid current assets that can be get at without any surrender or penalty? Are you planning for college or higher education for children? And how many years do you have until retirement? So these are just some of the questions that you need to ask yourself going into it. And we might not all have access to fancy financial planning software, but these are methods that you can use right at your own home to help you determine how much life insurance is appropriate. So that way you're not over insuring yourself. And let's get started. Hopefully this helps. So first off is the human life value calculation method. And I always say every human life is incalculable. We all have unique and beautiful characteristics, and we were made that way. What this is saying is that we're calculating our earnings potential over the course of our lives. And there's a couple steps to go through. The first one is to determine your income, subtract any taxes, insurance premiums, and any cost that would not be inquired if you personally were moved on to heaven and your family was still here. It might also be advantageous to include a conservative increase and to give yourself any reasonable raises that you may have. And a decent rule of thumb on this is you can probably expect that number, the overall final number, to be about 70% of what you were making. So if you were making $100,000, the income that your family will still need is at least $70,000. Moving on, after you calculate that, calculate the length of time that your income will need to be replaced. So for example, if our primary goal is to provide income in the event of a premature death to cover a mortgage, we only use the mortgage term. If the goal is to cover dependents, we use that length of time until they're majority. If the goal is to cover retirement and retirement planning, we can look at retirement age, whether that is 62 or 65 or whatever that may be. In the real world, though, really a lot of these things happen coincidentally. So it's probably best to just use a number like 65 or 60 or 70, whichever age you really would like to retire. And then finally, moving on, is multiply the income, the annual income needed by the number of years that we just talked about. So the number in step number 1, multiplied by the number in step number 2, and then we're going to take that number and calculate a present value of an income stream that would be produced for that. And there's a ton of calculators online that can do that for you. And then you'll come to a number at the end of that on how much insurance that you will need using this method. So next up, it's an offshoot of the human value calculation. That's income replacement. So really what we do is we take, it's a little bit simpler. We take the full value of someone's earnings potential. And in this approach, we take current income and we multiply it by the years we are expected to be working. So for example, let's say Jennifer she's looking to work for another 30 years. Her current income is $150,000. $150,000 times 30 to age retirement is $4.5 million in coverage needed. This approach will give you a pretty big number, and it could move you to being a little overinsured and paying a little bit more in premiums than you might normally do. So next up is the needs-based approach. And the needs-based approach calculates all current and future obligations and financial goals that we may have. We need to probably revisit our own personal accounting of our assets and liabilities, as well as our current household budget, to calculate the amount we will need on an annual basis to keep the family afloat if God forbid one of the spouses moves on to heaven. We can then at that time add in any unfunded future obligations or financial goals that we may have, like weddings or college expenses, things like that. And after we subtract any current assets we may have, these are assets that are liquid, that we can easily get to, that are not tied up, and any current existing insurance coverage that we already have. That gives us the final amount needed in this needs-based approach. And then finally, a good rule of thumb is what's called the 10 to 12 times approach. And really, this is a fantastic rule of thumb that I found is very easily digestible for folks. And really, it's 10 to 12 times your annual salary. You make $100,000, multiply that by 10 to 12 times, and that's the amount of coverage that you will need. If you're a Dave Ramsey fan, if you've researched this topic on the internet, I'm sure that you've come up with that. But you really can't go wrong with this approach. So if you're not looking to do a whole calculation and say, all right, so let's take our age, let's take our future obligations, and you want to keep it simple, you can't really go wrong with the 10 to 12 times approach. So to wrap it up, I can't stress this enough. A well thought out life insurance plan is a must for all families, especially young families who are just starting off their financial journey. And it doesn't need to be needlessly complicated. So the right approach depends on your unique situation. Having said that, you certainly can't go wrong with the 10 to 12 times approach to ensure that if anything happens to you or a loved one, your family doesn't face financial ruin. And I know, obviously, doing this over the years, it's not the easiest subject to discuss, but it's probably one of the most vital and important to have. We always say, what good is accumulating assets if you're not going to have a protection plan in place, just in case something, God forbid, were to happen? And I have noticed over the years that simply having a plan in place for not just money, but for kids, pets, other assets, aging parents, just having a plan makes an extremely difficult and sad time a lot easier to deal with and not add to the stressful burden about money and trying to figure that stuff out while you're going through a very traumatic experience. So hopefully this helped. If you have any questions, reach out. We're always willing and happy to discuss anything. And I do appreciate it. And until the next video, be good to yourself and be good to others. And have a great day. Thanks.